If you walk through a busy local market, you will notice that the prices of everyday goods don't stay perfectly still. They bounce around, and that movement is driven by the mood of the crowd, just as much as the actual supply of tomatoes or rice. Auntie Abena is a veteran trader who has successfully run her stall for decades because she watches human nature. She knows people will happily pay more when they feel festive, and they tighten their purses when they feel anxious. The global stock market operates on those exact same two forces. Behind all the complicated math and flashing screens, the prices on Wall Street are determined by the actual financial health of a business and the human psychology of how people feel about that business. Most people get completely swept up in those feelings, but mastering this psychological element is what separates a professional who builds long-term wealth from an amateur who panics and loses what they've worked for. Imagine the market pendulum swinging between fear and greed. At greed, investing feels safe, but your risk is highest. When it swings to fear, prices crash and people panic. Yet, with quality companies so cheap, your financial risk is actually at its lowest. The goal is to move against the swing of that pendulum, learning how to be cautious when others are greedy, and finding the courage to be brave when others are afraid. Think of the market as passing through seasons. The first is a quiet phase. Following a tough economic period, the market feels empty and depressed. But this is exactly when experienced buyers quietly step in to scoop up high-quality investments at a deep discount. That quiet period gradually warms up into a boom. People have stable jobs, businesses are making profits, and it is cheap to borrow money. As the economy expands, prices rise steadily alongside it. As those early buyers start showing off their gains, the media catches on. Soon, crowds of people rush in to buy, driven entirely by the fear of missing out on the excitement. This mass excitement leads to extreme overconfidence. People begin paying outrageous prices for companies that have no actual value, simply because they believe someone else will pay an even higher price tomorrow. When everyone around you starts feeling like a financial genius, the risk is at its peak. Overconfidence leads to dangerous debt, and the longer a boom lasts, the closer the entire system gets to a breaking point. Next comes the peak. On the surface, the public is still optimistic, but underneath, the actual economy is starting to slow down. The experienced buyers who bought during the quiet phase now take advantage of the excitement, quietly selling their investments to the latecomers to secure their profits. Then a piece of bad news triggers a reset. The bubble pops. The latecomers realize their mistake and panic, desperately selling off their investments at massive losses just to escape. Prices plummet, falling much faster than they ever rose. This electronic stock ticker shows the reality of the 2008 financial crisis. Excessive debt triggered a global banking meltdown, completely erasing years of growth for those who bought at the peak. This graph shows the onset of the 2020 pandemic. You can see how fast a modern panic moves, wiping out a third of the market's total value in just 33 days. While these drops feel like a disaster, they act like a cleansing mechanism for the economy. They wipe out failing businesses and put the strongest, healthiest companies on sale. These resets are where long-term wealth is actually made, provided you can remain rational while everyone else is panicking. Let's look at a younger trader, Kwame. He bought in during the boom, and now he's caught in a reset. Watching his screen turn red, he feels an overwhelming urge to sell everything immediately just to stop the pain. Fighting that urge is harder today. Social media and high-speed apps accelerate the cycle, hitting investors with a constant barrage of noise and digital panic. Kwame assumes he can sell now and buy back in right before things get better, but predicting the exact day the market hits the bottom is a fool's errand. This chart shows the danger of guessing. The biggest single-day gains often happen right in the middle of a terrible crash. If you miss just the 10 best days over a decade, you cut your total return in half. The data is clear. The time you spend in the market is much more important than trying to time the market. So how do you handle the roller coaster without using your emotions? You use a mechanical strategy called balancing the basket. Set a target ratio, 60% risky stocks, 40% safe cash. During a boom, stocks grow, tipping the scale. You sell expensive stocks for cash. When markets crash, stocks shrink. You restore balance by using that cash to buy investments back while they're cheap. By following this math, you take your feelings out of the equation. It forces you to sell high when you feel overconfident and buy low when you feel afraid. The market has recovered from every single crash in its history. If you stay the course and refuse to sell in fear, ultimately the cycle is not something to be afraid of. It is the engine that builds your wealth.